If you don't close on your home loan in 30 days or less, the lender you're working with sucks. Well, loans don't close in a week or 2 weeks. They typically do. The benchmark is 30 days or less. But the reason is rate locks could expire and then you're burning money for nothing. Documents could expire and you have to keep re-giving your documents. So typically, if you don't close on your home loan in 30 days or less, all hell always breaks loose. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner, that's right, 3 years in a row winner of NAMBY Broker of the Year, top originator across the country via Scotsman Guide, girled out extraordinaire, and just someone who straight up lives the dream. So here's a story about a client who almost wasn't able to close on time, which is super problematic, which is not the T, and it takes place in a land far, far away. Let's call it Huntington, New York. So 100 years ago when I used to have hair, my oldest daughter was super young. We were chilling on the couch watching CoComelon. Are we there yet? Not yet. My brain was dying. All of a sudden, no, I didn't lose my daughter. All of a sudden, my phone rang, and as much as I'm a present parent, I did take a peek to see who was calling, and a top agent, let's just call him, I don't know, Zach. So, of course, I pick up the phone when Zach calls, and as classy as can be, top producing agent goes, "Suh, dude." So me and Zach talked through a scenario. So we had a client, and now it was very important that that client close on that home purchase because they had a child, and that child actually needed an IEP at school, or an individualized education plan. In other words, they were going into a school district that had great services for their child to help them excel in school. Their current district just wasn't cutting it, so they were super excited about that. It was going to be great for their child. It was a bigger house. It was going to be a great situation through and through. But the lender they were working with, they were starting to get close to the contract deadline from a closing date perspective. No closing date in sight. And they were even kind of throwing out there, hey, maybe you got to put more money down, another 50 grand, another 50 grand. And these people just didn't have the 50,000. So I was able to get on the phone with the client, with Zach, talk through the whole circumstance top down. And it just didn't make any sense to me why they had to put more money down, or let alone why they weren't clear to close. You know, easy transaction. Two W-2 employees making hourly and overtime and bonus, nothing too crazy. So it turned out the lender they were working with, there was a verification of employment form. So when you make variable income, right? What is variable income? Hourly, because it's not always the same hours each week. Overtime, it's not always the same. Could go up, could go down. And bonus, it's not always the same. It's called variable income. There's basic guidelines that mortgage professionals follow. And one of them is you just literally old school it. You email out a form, and that form gets filled out. And on that form, there's a box that says, will this income continue? So for the bonus, the father was very bonus heavy. The HR forgot to check off, it will continue. So because of that, they just straight up forgot to do it. Didn't even think it was a big deal. They just kind of, half whatever filled out the form and sent it back to the lender. So because of that, they didn't have enough income on paper towards the tail end of the process, and they just weren't going to qualify to buy the house. And for whatever reason, the loan officer at the lender was not doing a good job communicating that to the borrower. They're super anxious. They don't know if they're going to be able to move in for their kid. A lot of emotions. So, obviously they gave Andrew a call to try to save the day. So with that said, I actually took my oldest, threw her over my back, not literally, went to the office, met the clients, took all the information, did the initial application with them. We went over together, they signed off on it, and the following Monday, we started the process. Now, we as well, we had to send out that form for the HR to fill out for the husband about the bonus income, right? The variable income. And they, again, didn't fill out that box. They didn't check off the box. We gave them a call. We're like, listen, if that income is going to continue for mortgage purposes, right? I know it doesn't make any sense to the HR world, but HR employees don't realize if they don't fill out these forms for mortgage professionals, it could affect the ability for employees at that firm to get a mortgage. We called them. We talked to them like, look, there was actually in section 14, call it, check off yes. If the answer is no, check off no. So they obviously went back, they filled out the form, they checked off yes, because the bonus was likely to continue. It was there for a handful of years. And because of that, it was one of the easiest transactions I ever did in my life. We were able to, Saturday took the call, right? Me, oldest daughter, took the call, CoComelon. Monday, we started the process, ordered a new appraisal, and they actually closed by the following Wednesday. It was about a 9-day clear to close. It was amazing. But it just goes to show you that if you work with the wrong lender or in the wrong situation, I think they were going, in month number 2, like day 50, day 55, and it only took us 9 days. And I know you're saying, hey, Andrew, not everybody's vanilla, right? Not everybody's leveraging to employees. So that's not the case. Even a non-QM, even a self-employed loan, even DSCR loans, the more difficult loans, a 30-day or less close is the expectation. I can hear right now, hey, Andrew, you're more expensive than that other, and that's not the case. All lenders, mortgages pretty much commoditized. Yeah, there's cheaper here and there, but who you work with plays the biggest role in your success. So I'm going to draw out the 9 steps to success to ensure your 30-day close is not just a pipe dream, it's a guarantee, and you could take this as an expectation with the lender you're working with. So the first 3 steps are the pre-approval. Yes, it begins with the pre-approval. If the pre-approval is done wrong or it's not fully efficient, every other step will have an issue. So the first is the pre-approval. The second, on a purchase, would be an accepted offer. Obviously, you have to go out and see properties. You make an offer. Oh my God, OMG, one's accepted. That's the next piece. Things happen then. And then third is the initial application, meaning you're in contract. There's an initial application that goes out, what to expect. So the pre-approval. The pre-approval is very important because if you think about it, there have been statistics across the country that over 50% of pre-approvals done in America have some form of an issue where it was either done wrong or there's some kind of gray area that was missed that'll cause an issue downstream. Like take, for instance, the story I told you. They probably on the pre-approval side didn't send out that verification of employment form where that box would have had to have been checked. So the pre-approval in that case, it's not that it wasn't done correct. They didn't do the full gamut of steps to ensure that it was a flawless pre-approval. I kind of came in last minute and figured it all out. But that's an example of why the pre-approval is so important. The pre-approval, you get your credit, your income, your assets checked. You take a hypothetical scenario, let's say $1 million house with 20% down. You get your 30 days of pay stubs or tax returns for a handful of years, look at all the asset accounts, run the credit, and make sure from a debt-to-income perspective, meaning how much debt do you have versus your income, what's your credit score, what's your credit profile, how much money do you have saved, are you getting a gift from family, you got all sorts of money in crypto waiting for it to go to the moon. There's so much that goes into it. The pre-approval is the most important part, but many times it's breezed through. Once you're pre-approved and you're out there looking at properties, of course, the next step is the accepted offer. Once your offer is accepted, at that point, the most important thing is the loan officer, the sales professional you're working with, to come in and to get the necessary documents to get ready for when we get the contract. Now, remember, when you make an offer, you then have to go into contract, which is a legal document. And between that, the pre-approval to accepted offer, it could be the same weekend, it could be 2 months later, it could be 7 months later, and you have to re-up the pre-approval. So at that point, it's the most important thing. What's changed since the pre-approval? Same job, get a refresh of pay stubs or income documents. You might need your credit pulled yet again. And that is something that's super important at the accepted offer milestone, only because if something changed from the pre-approval side, again, there might be an issue and you don't want to go into contract, into a legally binding document if there's going to be an issue or you just don't qualify because a lot of time has elapsed since the pre-approval. So let's assume you were pre-approved, you made an offer, it was accepted, now you have the contract. The third piece is the initial application. So your loan officer and the lender you're working with is going to prepare a very lengthy, tons of pages, lots of stuff. The most important within that application is the loan estimate. The loan estimate is going to go over with you the rate. It's typically a floating interest rate if you're not locking right away. That's kind of up to you, and it's state specific, but it goes over the rate, the payment, all the good stuff. And then the second page is where you see itemize all the closing costs. You kind of see what the lender's charging. A lot of fees can't be changed, or if they are, believe it or not, the lender actually has to pay for it. It's really not that funny. I don't know why I'm laughing. It actually stings on the back end. It's happened to everyone in the industry, but there's a lot of regulation. So what is shown on the loan estimate, the most important document to me, there's a lot of things on there that can change, so you're protected, that there can never be surprises. So You pre-approved. You got an accepted offer. You had your initial application. You went over it with the lender. You e-signed it because we're living in a, I mean, listen, AI technology is the new wave. E-sign is 10, 20 years ago at this point. But you e-sign it, which means you e-sign the intent to proceed form. You are ready to rock and roll with that lender. You're committing to use them to apply for your mortgage. Now, the next 3 steps are you're going to have an appraisal that's ordered typically. So an appraisal order. You're going to have a title that's ordered typically, so we'll call that title order. And then hopefully you get your conditional approval from the lender. So what does this all mean? The appraisal order. So if you're buying a house, again, remember $1 million, 20% down. The bank is not lending off of that sale price that you've committed to, the $1 million. Maybe you put 10% down on contract as a retainer, a deposit, call it $100,000. The bank is lending off the collateral, which is the specific property you're buying. They're going to go off the appraised value. So they will have an appraisal team. The lender will order the appraisal. It gets outsourced to an appraisal division. And you can't choose the appraiser. That's illegal. That's a big no-no. But they want to make sure a third party that's not interested in the exact transaction, someone that's interested in making sure the right valuation comes in, they're going to go out and appraise the property. Typically, they walk through it. They check for any health and safety issues. They compare it to, you say you're buying a one-family. Is it actually a one-family? They kind of check the GLA, which is the gross living area, the square footage. Does it have a basement? All that stuff. They put it all together, and they put it on a document. Usually it takes 3 to 5 days to get the results, which we'll talk through a turn time for all this stuff. But that's the appraisal side because, again, the bank is only going to lend off what that collateral is actually worth, not what you want to buy it for. So if that $1 million house you're buying is only worth $800,000, they're going to give you a loan based on that $800,000, not that $1 million. It's very important, the appraisal side for the lender. The second piece is the title order. So what is title? Title insurance. Title insurance is basically, you ever had a car, got in a car accident, and you had insurance? Title insurance is very similar. When you buy a house, there's a deed, whether it's new construction and you're the first one typically, or it's a house that's been resold and it's going from Jane Doe to you, John Doe. Not that there's any relation. So if it goes to you, you have to make sure that they actually own the house. So when they sign it over to you, that you actually own it as well. It's free of any liens or encumbrances and all that good stuff. Meaning, what if there's a $200,000 mortgage that didn't show up on the title report, and then you buy the house, and now all of a sudden it's still on the title of the property, it's still against the property itself, and they're coming to you to pay it. So that's a title issue. So it's very important to get title insurance, and that's within this whole title report process. The title report is always ordered at around this time, and we'll see what happens with that in a little bit. And the third piece is, once you e-sign, again, follow the journey, right? Pre-approved, accepted offer, contracts in, initial application, you sign it, cool. Let's submit for initial approval from the lender side. We order the appraisal, the title's ordered, whether it's by an attorney or the realtor or whomever. Now, the conditional approval side, we submit your loan application to the lender, to the underwriter, right? In front of the underwriter, they'll get a copy of the contract, your income documents. They'll review your credit. They'll look at your assets, and they say either a big fat yes or a big fat no. Now, a big fat no is almost impossible. Typically, salespeople, loan officers, when you submit for approval, you should bat 1,000. Imagine you're working with a loan officer and he made a mistake and says, hey guys, we just submitted your loan for initial review. My bad, made a boo-boo, you didn't qualify, you just wasted money on appraisal, you're going to get declined for the mortgage, you got to get your money back. Like, that just purely sucks. Typically, loans are always approved, and an expectation turn time is from when you sign your initial application, within 1, 2-ish, maybe 3 days, your initial conditional approval should come out from the underwriter. Now, that doesn't mean you're ready to close. It just means you're going to get a new list, typically easy stuff, and when you send that stuff into the lender side, you're going to satisfy your end. Because remember, it's a 3-pronged process for you to be able to close. The appraisal, the title, and of course, your credit. So remember, it's a 3-pronged approach for you to close and close on time in under 30 days. You have the appraisal side, which is that property you're buying worth what you're actually buying it for? You have the title side, which is the whole chain of title, and you buying from the seller, do they actually own it? Will you actually be able to purchase it and have no issues? Are there any liens that have to be extinguished? all that good stuff. And then the third piece is you, your credit, your income, your assets, your ability to buy outside of the appraisal and title. That's the third piece. So the next 3 steps are, and the final ones before the good news, we're going to use green for money. The appraisal results, the title results, and of course, music. And of course, music to your ears, the CTC, the clear to close. What does that all mean? And after this, we'll talk turn times and expectations. So remember, we order the appraisal. The bank wants to make sure that the property is worth what you're buying it for. So the appraisal results will be coming within 3 to 5 days max from when the appraiser sees the property. Within the appraisal, they're going to compare it to 3 to 5 other properties. They want to make sure, is the market stable, increasing, or declining? So if it's stable, all good. If it's increasing, you might be able to buy something if it's the highest sale in the neighborhood. So if you're buying it for $1 million, but the highest sale with a similar house is only $980,000, typically it's really hard to get that $1 million to come in from a valuation perspective because there's no other comparables that are similar, right? But in an increasing market, you might have a chance. Now, declining market is tough. Declining market is no bueno. It means if the same house, say for $1 million, sold 6 months ago and the market's declining, your house won't be worth $1 million because the market's declining month over month. So these are things the appraiser checks for, along with, comparing it to what's sold, comes up with the final valuation. If it hits it right on the mark, say that $1 million, you're good to go. The appraisal's in, it's cleared. That's one thing done. The second piece is your title. Title comes in. We want to make sure that the seller is actually the seller, that they didn't inherit the house and the 2 other brothers are unaware that they're trying to sell it. Things happen, folks. This is why you get a title report. That there's no liens that nobody knew of. So when title comes in, it's reviewed by whichever party, whether it's an attorney or the realtor or whomever, and it's cleared. The second piece is done. Now, the most important is you, the clear to close on the lender side. After the first 2 pieces are cleared, it's more so you, where there are letters of explanation, where there are job gaps that we had to kind of situate, was there a CPA, because you're self-employed involved, we had to get a certain letter, bank statements, did you have a large deposit? Maybe, this couple was just married, for instance. They have some large deposits from a wedding. It's always a bit of a drama. So there's always some stuff at the conditional approval side that's asked for. Typically, 4 items, 6 items from a client is the norm. But when you send that into your lender, it goes back to the underwriting department, and it's a 3-pronged approach. Yet again, they clear the appraisal, they clear the title, and then all the small miscellaneous stuff on your end, they clear those items as well. And then, of course, they issue the magic clear to close, which is music to your ears. It means you are all good, you are done, and it is now time to schedule the closing. Now, the most important is from a turn time expectation to make sure it's always 30 days or less. Let's look at the timing. So pre-approval is kind of out, right? Because pre-approval doesn't have any correlation to when you're actually in contract buying a property. The accepted offer, kind of out. So it's really the initial application is when we start, because that means you're in contract and the lender's sending your initial application. So within 1 day, you should receive max with current turn times your initial application for review. Let's say you sign that, and again, we're going to be conservative, by day 2. So now we're 2 days into the whole transaction. After being in 2 days, the lender will order your appraisal. Let's just say that takes a day. Title will be ordered, and they're going to submit your loan in for conditional approval. So this should take no more than another 2 days. So now you're up to about 4 to 5 days. So there you go. So let's say the appraisal, you're a couple days in, it's ordered, it's scheduled 3 days later. It takes another 5 days to come in. So that's plus 10 days from here, right? So from the first day. So let's say the appraisal and title come in another 5 days. So now you're 10 days into it. So you're 10 days in with an initial approval, items needed from you, but the appraisal and title have been in, reviewed, and cleared by the lender underwriter. So from here, 5 days in to work on your own personal clear, right? Reviewing the letters, CPA letters, whatever it is, maybe some more income information is needed. This should not take more than 10 days. And this is, of course, based on you being cooperative. But with that said, as you can see, if you add all this together, it's all kind of happening concurrently. The whole process, 15 days, is a perfect number if everyone's cooperating from submission to clear to close. So my point is, If we started with the big promise here of 30 days, if you're cooperative and everyone's doing their job, there's no way. So, as you can see, when we started with a 30-day big promise here, if the lender knows what they're doing, it only takes 15 days if you're cooperative and everyone's doing their job. So as you can see here, this is a true expectation of what you should expect when you go to buy a home or even do a refinance. A 30-day close or less. I mean, we gave an example of 15 days, but who do you choose? There's so many places you can choose. There's credit unions, there's banks, there's mortgage broker companies. What the heck is that? So make sure, guys, you tune into our next video. Our next video, we're going to talk about who you should use when you're getting a mortgage and the differences of all of them and who's the best.